Okay, today we are looking at pricing chapter. What I'm going to do is first skim through the theoretical parts in this chapter and then come to the numerical parts. Okay, first thing first, let's look at the factors influencing price. What are the things that helps us decide price? First thing, demand. And in this chapter, in numerical part, we are mostly looking at the relationship of price and demand. So when demand for product is higher, we can charge higher price. When demand for product is lower, we have to charge lower price. Quality, some products have a higher quality, so there is a higher price for them. Some products have lower quality, there is lower price for them. Competitors, what competitors are charging also decides the price that we are going to charge. If they're charging lower price, we have to charge lower price. If they're charging higher price, we have to charge higher price. Opposite can also happen, but these are the things that usually happen. Substitute products. So the substitute products are those products that can be used instead of our product. So if substitute products price is higher, we can charge higher price. If substitute products price is lower, we can charge lower price. Because if we charge higher price, then people can go to the substitute product if the substitute product's price is lower. Inflation is the idea that with time the prices of thing is going to increase. So what you bought last year, this year it is going to be expensive. Age of product. Some things usually specific products, the older they are, the expensive they can be sold. For example, cheese or wine. And disposable income depends on the income of the society. So the people with higher income would usually be able to pay higher for a product, and people with lower income would be able to pay lower for the product. Okay, next we have pricing strategy. So which simply means whenever we are deciding price of a product, how would we come about deciding the price? So one thing would be simply using cost plus pricing. We already saw this in target costing, where we find the cost of the product and we apply a profit margin to it, and that would be our selling price. But remember, this only works when there isn't any competition. If there is competition, then our price might not be very relevant. So we could use different ways of cost plus pricing. One could be using full absorption cost, which would mean that we will be able to cover our fixed cost as well if we sell a certain number of units. Or another thing could be just using marginal costing, or we could use relevant cost. Remember, relevant cost would be the minimum cost of the product. It will help us decide the minimum price of a product. We already saw this in decision making, so the concept here is the same. Or we could use standard cost, which is the normal cost that we would usually use. So the advantages and disadvantages are the usual that we saw in target costing. Okay, next, market penetration and market skimming. Whenever we have a product that we want to launch in the product, there are two ways we could do it. One thing would be charging lower price, which would be market penetration. And then another strategy to use would be market skimming, which is charging higher price. Now, market penetration simply means that we want to enter in the market, and if you want to enter in the market quickly, so what you do is you charge lower price so the more people can buy your product. And both of these strategies are used in different situations. Market penetration would be used in a situation usually when product is already in the market, competitors are charging a price. If you charge higher price, then customer would not buy the product. And also, even if the product doesn't exist in the market, if you want the other people to see your price, and they would be discouraged if you're charging a lower price for a product and then competitors see that you're charging lower price, they will not be happy about entering the market, because they can see that it will be very difficult to secure profits. And another reason is economy of scale. Even though you will be making less profit per unit, but multiplying by the total number of units that you're selling, ultimately the profit will increase. And it would be used in a situation where the price is elastic, which simply means that people are very sensitive to the price. If people are very sensitive to the price, the best approach is to reduce the price. If people are not sensitive to the price, good approach is to increase price. If people are sensitive to the price, good approach is to decrease price. Market skimming is charging higher price, and it is usually used in a situation where the product is not available in the market, so you can charge as much higher as possible. Your intention is to collect the profit as soon as possible, and usually it will be applied to a product that have a shorter life cycle. You are not worried about making profit for many years. It is a new product you are releasing into the market. It will be available for 1 or 2 years, so all the profit that exists you want to collect from the market. So when new people come, when new competitors come to the market, you've already collected the profits. Price discrimination is using different price for the same product. So discrimination simply means difference. So discrimination could be done by different ways. You could discriminate by market segment. In a market, for different segment, you could charge different prices. Like age, for older people the price could be bigger, or for uh, young people or students it could be lower price. You could differentiate it by versions. There could be different versions of a product, like you have in cold drinks, you have sugar-free, and usually the sugar-free is expensive. By place, in different places prices could be different, and usually it could be because of the income that people have in those different places. You could differentiate by time of the year or time of the day, like in special occasions, in Christmas or New Year's, prices are usually reduced. Or if we talk about during the day, usually internet service providers, late night, the charges are lower than during the day. But remember, whenever you are doing discrimination, there shouldn't be any black market, which means that people would buy in the market where the price is lower, and then they will bring it to the market where price is higher. So if you can stop that from happening, if you can control that, then discrimination will work. Otherwise, it would create problems. Product line pricing would be when you are looking at the profits that you make from all range of your products. Maybe some products that you are selling are not as much profitable as you would hope, but you are not thinking about the profit from that particular product. Usually you would sell a particular product at loss, but you are looking at the combination of the product, the profit that you're making from all the products that you're selling. Like in a maybe in a superstore, some of the products that a superstore is selling would not be making as much profit, but when a customer comes to buy that particular product, they will buy other products as well, in which the company or the store could make profits. Complementary product pricing is when, a good example of this I will give you is printer. Let's say you sell printer at lower price, you don't make as much profit in it, but when the ink runs out, the toner has to be replaced, you make profit in that toner. Or it could be used with razors, where the razor itself is sold cheaper, but when the blades are changed, you're making profits in those blades. Volume discount is when you give discount to the customer based on the quantity that they purchase. Usually when things are bought in large quantities, because of the economy of scale in the production, in the material that you're purchasing, in the delivery, cost is saved. So that's why you would offer discount. Relevant cost pricing, as we saw above, it would be pricing the product at relevant cost, but relevant cost would be the minimum price that you're charging. Okay, other considerations. We are not just looking at the profit or the financial factors when we are deciding price. We have to look at the non-financial factors as well, like what are the objectives of the company, the long-term objective, the short-term objective. Like, for example, in market skimming, if you sell the product at a higher price, people now will buy it, but later on, when other competitors are coming and they charge lower price, then the reputation of the company could be negatively affected. So if your intention is long-term, then market skimming would not be a good idea. Competition in markets. So we have to look at the competition as well in the market, what the competitors are doing, what products they are selling, what price they are charging. Production capacity. If we charge lower price for a product, then what will happen is the demand for that will increase. And when demand increases, do we actually meet that demand or not? If we decrease price, demand increases, we're not able to meet the demand, then it will negatively affect the reputation of the company. Product life cycle, as we saw in life cycle costing, at different stages of the life cycle of a product, we could charge different prices. Like at maturity, at introduction stage, if we decrease price of the product a little bit, demand can grow a lot, but at maturity stage, decreasing price would not affect demand as much. And also, the price that we charge would depend on the innovation that we are doing, the quality that we are bringing to the customers, the technology that we are bringing. The customer's buying power. If customers will have buying power when suppliers are more and customers are less. So in that situation, you have to charge a price that the customer wants, which means lower competitive price. Other products in range, like products, the substitute products, and other supplementary products will decide the prices we are charging. Availability of resources. If we decrease price, demand increases. Do we have enough resources available to meet the demand, or the resources available could be less, which means it will be very expensive to collect the resources, hence our cost could increase. Impact on staff. If we charge higher or lower price, what impact does that have on the motivation of the staff? For example, if we charge higher price, our staff could believe that it is unethical and maybe they leave the company. Impact on customers, likewise, if we charge higher price where the availability is less, that they could feel betrayed, they could leave the company and they could go to another competitor. Competitor's reaction, what will the competitor will do? If we decrease price, what the competitor will do? They will also decrease the price. So sometimes decreasing price is not a good idea. Opportunity costs. Opportunity cost will be, for example, we have quantity available that we could sell at higher price. If we sell them at lower price, we will make lower profit. If we had sold them at higher price, we would have made higher profit. Impact on other products. Sometimes when we are charging lower price for a product, let's say, the demand for that particular product increases, but we have other products as well that we are selling, though the demand for those products could reduce. So these were the theoretical parts in this chapter. Now let's look at the numerical parts. Okay, first thing we are looking at the relationship of price. Basically, in calculation, we are looking at the relationship of price and demand. The first thing we look at is price elasticity of demand, which simply means is demand affected by the price change or not? If it is affected, is it affected more or less? If it is affected more, we say it is elastic. If it is affected less, we say it is inelastic. We saw that in life cycle costing as well, where I told you that in introduction stage, demand is going to be elastic, which means a slight change in price would mean demand increases or decreases by high margin. Remember, normally, when prices decrease, demand is going to increase. And when price is increased, demand is going to decrease. That happens normally. Opposite can also happen. Sometimes what happens is you increase the price, demand increases because people think that the price is going to increase further, so they buy as much as possible. We are talking about the normal situation that happens normally. When you increase price, demand is going to decrease. So if we want to see the elasticity of demand, we use a formula called price elasticity of demand, which is percentage change in demand divided by percentage change in price. Remember, we are not looking at change, we're looking at percentage change. So if the percentage change in demand is higher than the percentage change in price, we say it is elastic. Okay, we have a question here. Let's answer that. Okay, the price of a good is 1.20 per unit and annual demand is 800,000 units. This is our current price and demand. Market research indicates that an increase in price of 10 cents per unit will result in fall in annual demand of 75,000. So if we look at the change in price, it is 10 cents, and if we divide that by the current price, that becomes about 8%. And when we look at the change in demand, dividing by the current demand, it's about 9%. So the change in percentage in demand is more than the change in percentage in price. So that means it should be elastic. So sometimes you forget whether it is demand divided by price or price divided by demand. Remember, when price is elastic, the answer should be more than 1, or if you are calculating in percentage, it should be more than 100%. So obviously, if I take this 9.73 and divide by 8.33, it will give me answer more than 1. If you calculate that as a percentage, it will be 112%, which means it is elastic. Usually, you don't have to calculate it in percentage unless specifically told. More than 1 means it is elastic. Less than 1 means it is inelastic. More than 1 means demand changes by more percentage. Less than 1 means demand changes by less percentage. Remember, we are calculating the change as a percentage. If I just take the cents and then divide it by, look at the change in cents and then taking the change in demand, then the answer could be very different. So we don't just look at the change, we look at the change in percentage. Okay, next we are looking something at look at something called demand equation, which simply calculates demand for a given price and price for a given demand. So if I tell you the price of a product is going to be 15, what is going to be demand at that price is going to be found by this equation. Or if I tell you I want to sell 100 units, what is going to be the price that I'm going to charge is going to be found by this equation. So demand equation is P equals A minus BQ. P is the price that we are finding, Q is the quantity, and A is the price at which demand is going to be nil. So what is the price at which demand is going to be zero? Remember, when we increase price, demand is going to decrease. There will be a point where demand is going to be nil. Customer believes that at that price, no one is going to buy it. So theoretically, it doesn't have to be practical. And then B is the change in price divided by change in demand. So here we are not looking at percentage. Here we are looking at the change in price divided by change in demand, not as a percentage. So we have a question here. Let's see. The current price of a product is 12. At this price, the company sells 60 units items a month. 1 month, the company decides to raise the price to 15, but only 45 items are sold at this price. Determine the demand equation, which is assumed to be straight line equation. Okay, so first let's find A, which is the price at which demand is going to be nil. Okay, so they said here, when price is changed to 15, which is 3 change in price, demand changes to 45, which is 15 change in demand. So 15 change in demand for every $3 change in price. Or we could do it like this. 15 divided by 3 becomes 5 change in demand per dollar change in price. Okay, so if our current demand is 60, remember everything we are looking at relation to the current price and current demand. So divide that by 15 becomes 4 times 3. Or we could do it like this. 60 divided by 5 becomes 12. If you take 4 multiplied by 3, it gives you the same 12. So 12 change in price. Our current price is 12. So if we change it by 12, which becomes 24, so this is the price at which demand is going to be nil. Next is B, change in price divided by change in demand, simply changing the 3 divided by 15, which is 0.20, or you could just take 1 divided by 5, which becomes 0.20, whichever you seem is right. Okay, now we can make the equation as 24 minus B, which is 0.20, multiplied by demand. For example, at 60, it will give me the answer of 12. And this is finding price for a given demand. For a given price, I can find demand as well. For example, for this 15 price, I can find the demand. So 15 equals 24 minus 0.20 Q. So if we rearrange the equation, we could say 0.20 Q equals 24 minus 15, which becomes 0.20 Q equals 24 minus 15 equals 9. And then dividing both sides by 0.20, becomes 45. So for a given price, you can find the quantity. For a given quantity, you can find price. For example, you have a production capacity of 100 units. So you want to know, if you want to sell 100 units, what is the price that you're going to charge? It is going to give you the price. Okay, for example, if I say I want to sell 100 quantity, what is the price that I'm going to charge? It is going to give me $4. So I need to charge $4 in order for quantity to be 100. Okay, or we could give price and it will give you demand. But remember, that formula didn't give us any decision rule. It didn't tell us what price is right. It didn't tell us whether we should charge $13, whether we should charge $15, whether we should charge $16. So it didn't give us any decision. So changing that formula a little bit will give us that decision rule. If we take the same formula and we add 2, then we can find the price that we need to charge. There is idea that when you decrease price, demand is going to increase. So as you keep decreasing the price, your demand is going to increase. So the revenue that you will be earning is going to be more than the cost that you are spending, the variable or the incremental cost. But there will be a point where the incremental revenue that you're earning from the increase in price is going to be equal to the variable cost or the incremental cost. After that point, the profit is going to decrease. So conceptually, there is a point where the profit is going to be maximized. And that point is going to be where your marginal revenue equals to your marginal cost, which simply means the incremental revenue that you're earning from extra units is going to be the same as the revenue that the cost, the incremental cost that you're earning. So using this formula, we are going to find that quantity. Once we find that quantity, we can put it in the demand equation formula, which will give us the price. We have a question here. These are the steps shown here, but I will answer it and then you will know. Okay, ABCO has used market research to determine that if a price of 250 is charged for product G, demand will be 12,000 units. So this is our current price, current demand. It has also been established that demand will rise or fall by 5 units for every $1 fall or rise in the selling price, which is just like our previous example. The marginal cost of the product is 80. So using this formula, which is basically the same formula, just 2 is added here, and we will use marginal revenue or marginal cost here. So if marginal revenue is given or marginal cost is given, you can add it here because they're going to be the same. So let's answer this question. So we are finding the same thing we did in the previous example, the A and B. So first let's find A, which is the price at which demand is going to be null. So if we have 12,000 demand, and with every $1 change, quantity decreases by 5. That means we need 2,400 price change, which means our current price is 250. 2,400 change will make it 2,650 is the price at which demand is nil. B is the change in price divided by change in demand. So the change in price is 1, change in demand is 5, which is 0.20. So we can make the equation as marginal cost or marginal revenue equals 2,650 minus 0.20 multiplied by 2. Remember in formula we have 2, which will make it 4. So 0.20 multiplied by 2 will make it 0.40 multiplied by Q. So using this formula, we can find the quantity we need to sell. So rearranging the formula, you could say 0.40 Q equals 2650 minus 80, or 0.40 Q equals 2650 minus 80, 2570, or dividing both sides by 0.40, then Q equals 6425. So using this formula, marginal revenue or marginal cost formula, we found the quantity that we need to sell to maximize the profit. Now that we have the quantity, we can apply that to the formula to find the price. So same formula, but remember it is not multiplied by 2, so it is 0.20. The quantity is 2650. It will give us the price. Quantity is 6425. 6425. So 2650 minus 0.20 multiplied by 6425 equals, or if I put equal sign here, it will directly give me answer, which is 1365. Price is the price that we need to charge. If we charge 1365, our profit is going to be maximized. So they have shown that in the tabular format here to explain the idea. Look at that, you don't have to calculate it. And then something else here is a decision to increase production and sales. So sometimes what happens is our current capacity, obviously when our demand is higher and our capacity is lower, we might be able to increase our capacity. If demand is lower than our capacity, then there is no point in increasing capacity. So this is a situation where our demand is higher than our capacity. We want to know whether it is a good idea to increase our capacity or not. So the decision would be made by looking the cost by increasing the capacity and the further revenue that we are going to earn from increasing capacity. It is just like further processing decision that we saw. Very similar, not complicated idea, just involves common sense. So if the cost incurred is going to be less by increasing the capacity, and the extra revenue that we are going to earn is going to be more, then we will increase our capacity. Sometimes you might have seen in a business that we're especially in restaurants, where they have many customers waiting in line, and then you are thinking, why are they not increasing their capacity? Why are they not hiring another person? Why are they not increasing the space? It usually is because they think that when they increase the capacity, it is not going to be as much profitable. So this is it for pricing chapter.